Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. The market here in August last year, as elsewhere, constructed a new pattern. It built a mid-August to October ascending wedge pattern that is highlighted in dark blue on my daily chart. In mid-October, prices dropped out of this ascending wedge pattern, and after a reactionary move back up that failed, the market pushed down properly through all the moving averages, halting briefly at the 50% Fibonacci line of the March 2021 to May 2022 move at 315. In this move lower, the market showed an earlier bearish incentive compared to the other grain markets. So there were here, as elsewhere, two avenues for prices to travel. It chose the first avenue, which is a straightforward move down, with appropriate potential targets for the ascending wedge pattern. Thus, a primary target on the downside was in the 331 zone, whilst the secondary harder to reach target was way down in the 296 zone. The primary target was easily achieved, but it took until mid-December to reach the secondary target, which in its way is an achievement, as none of the other grain markets have managed as yet to reach a secondary target. I also posed a second question 4 weeks ago, and that was whether some of the supports would be enough to turn prices higher, and maybe, just maybe make a possible double bottom. Personally, I was not so sure last time, as we have so much ammunition above the market, which suggested the bearish incentive is still there. My sentiment of not being so sure of a double bottom type action was clarified 4 weeks ago when I retired the concept. So where does that leave us now? Well, I pondered this aloud 4 weeks ago, and thus, I quote, "Take a look at the whole big action since the peak in May today as just possibly a very large bearish halfway hesitation in the making. To clarify, it is possibly in the making and is not made, not yet. This is a ginormous pattern, and one which eventually leads down to something like the 225 area. I'm not prepared as yet to call it, not yet. However, we may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is a mid-June to date bear channel, currently 261 to 337, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favor the bearish side, then these are worth considering." End of quote. These still stand as ideas and as patterns. Both have merit. Perhaps the bearish halfway hesitation more than the bear channel. To these two, I'd add a further short-term pattern. A mid-November 2022 to late December 2022 bearish Andrews pitchfork, which has been excellent so far in indicating a bearish angle of attack. The market is either side of the middle tie, currently at 282 and marked in red on my and trend lines marked in the time lines marked in red on my daily chart. But because of its relatively small size, it's worth looking at both the upper time, currently at 294, and also the lower time, currently 269. London, UK feed wheat. From mid-July to the end of September last year, we had a shallowly bearish channel that morphed into a shallowly descending, broadening wedge pattern, which morphed again in mid-August into a bull channel. This bull channel is the one highlighted in dark blue on my daily chart. In mid-October, the market made a weekly key reversal down that broke down through the lower bull channel line and started the next major piece of action, a move lower. Prices additionally broke down through all the moving averages, and the moving averages formed two dead crosses as a result, one in early November and one in early December. Please note, these are lagging bearish indicators, but they are still bearish indicators. So if the breakdown through the original lower bull channel line, it left us here, as elsewhere in other grain markets, with what were two avenues going forward. Eventually, the market chose the first of the two. I described it thus 7 weeks ago, and I quote, "The first is a straightforward move down, with potential targets for the break below the bull channel. In this case, a primary target on the downside was already achieved in the 269 zone, whilst the secondary hard to reach target X1 is almost achieved in the 239 zone. Prices dropped down in early December and reached target X1 in the 239 zone. I also laid out 7 weeks ago the next possible scenario, and I quote, "We now have to see if the 239 zone will hold this decline, which includes a previous all-time high at 238 3/4. If it doesn't, then there is a series of old congestions, some dating from 2012 between 230.10 and 223.10, and another dating from 2013 between 215 to 217.80. These may in turn be in the frame, but let's see what the 239 zone holds in store." End of quote. Once reaching 239, prices hesitated, as I thought they might. But in early January, they resumed their journey lower. It is at this point I will bring in my last words from 6 weeks ago of a potentially new pattern, and I quote, "There is one potentially new factor to add into the mix. I'm not even sure if it is genuine or not as yet, but we may have an October to date small bear channel. Currently that's 202.5 to 238. I've added it onto my daily chart, but for the moment I've chosen not to highlight it, at least until I can see it perform. The one thing it has in its favour is that the short medium moving average, currently 229.25, seems to be paralleling it." And that's the end of the quote. 4 weeks ago I decided to highlight this bear channel in purple, as it was and still is showing an excellent idea of the bearish angle attack of the market. The only amendment I've added since then is a bright green, shallower amended bear channel, currently at 213.25, 230.5, as it seems a better fit if you take the breach above the upper bear channel line of the original bear channel into account. Both these deserve closer scrutiny, as at some point the market will have to choose which one it will follow, if at all. That moment will be towards the middle to end of February, when the two bear channels part their ways. So we haven't really that much time. Whilst this is all happening, I asked this question last time, and I wish to reprise the commentary today as it is increasingly relevant. The original question was, and I quote, "What's next?" Well, prices are now running into a congestion band below, between 223 to 230, which has the 2012 high within it. It is a reasonable piece of a congestion, but it may be no match for all the ammunition stored overhead between July and October. Thus we need to look a little further, and this is where the way out ideas come to light. What if the action since mid-May to date is a huge bearish half hesitation, a really, really big one? In that case, we will be looking at potential down in the 180 even area. Yes, 180. I am not as yet advocating this as a pattern, but it might turn out to be so. It will depend on how the market treats the congestion below, between 230 to 223, and the smaller ones between 215 to 217.80 and between 205 and 206.40. Watch carefully, especially the integrity of the bear channel in purple. End of quote. Well, I decided today to place a potential target X in the 180 area.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.